All right. Welcome, everyone. My name is Jill Franks, and I'm here with Ashley McVicker and John Streuter
Hello.
for Mortgage 101. We haven't done any of these for a while, so we wanted to come back to it. And there's a lot going on right now with interest rates and mortgages and the housing market and all of that. So we wanted to come back and do another live event today and just give you an update on what is going on in the marketplace. So with that, I am going to turn it right away over to John Streeter, who is the Executive Vice President here at Farmers State Bank, and he is also our Chief Mortgage Officer. So he is the guy to go to when you have a question about mortgages. So we'll just let you do a quick intro, John.
Good afternoon, everybody. As we've been on this show a few times before, but I think was almost, I don't know, our last show may have been pre-COVID, now I think about it. But it's an opportune time to talk about what's going on in the marketplace, and glad to be here with you.
Great. So today, Ashley, what are we talking about today?
Today we are going to talk about ARM. We are going to talk about variable rates. So exciting. And I think a lot of people have plenty of questions about this, but John is going to get into that. But John, I want to know, first of all, I want you to give us a market update. Jill touched on it earlier, but it seems like everybody is going crazy with the news. They want to know, what are these interest rates? Are they even bad? We heard how amazing this 2% rate was a year ago, and now they seem to be skyrocketing. But we just want to know, give us a market update.
Sure. So like everything with inflation, rates are going up, and many people are hearing about the Federal Reserve raising rates to combat inflation, which is not really how mortgage rates go up. Mortgage rates go up when the stock market and the bond market go up and down. Right now, what we're seeing is that a lot of people are pulling out of the bond market and the stock market because of the downward trend, and that's causing bond yields to go up, and that's what's causing mortgage rates to go up. So mortgage rates increasing is somewhat of a connection to the inflation, but not a direct result of inflation. It's really the bond market that's turned upside down that's caused mortgage rates to go up. Having said that, we continue to expect rates to continue to go up. Probably we'll be looking at fixed rates nearing 7% by the end of the year. They have toned down a little bit. A week ago, the 30-year fixed rate was as high as 6.75. Today, the 30-year fixed rate is 6.25. The 15-year had gotten to 5.75. It's trickled back down to 5.5. So, but that's much higher than the 2s and the 3s that we heard a year ago and 2 years ago. And a lot of that's because those rates were pushed down on purpose by the Federal Reserve in order to get rates low and get the economy moving. Normal investors were not buying mortgage-backed securities. It was the federal government who was buying mortgage-backed securities, and the federal government can buy those securities at lower rates. So they were pushing those rates down. Now, what started the mortgage increase is the Federal Reserve said we're not going to buy mortgage-backed securities anymore. So they have to, Freddie Mac, Fannie Mae, and other large banks have to offer those to general investors. And general investors are saying, we're not going to buy them at 1 or 2%. We're going to buy them, we'll buy them at 4 or 5%. And then that's what started the huge increase. So it is part of the ebb and flow of the mortgage business, but because of all the other inflationary trends, we are going to see it continue to tick up. Also, we think that those rates are high, but notoriously historically they're not. My first fixed rate was 10.125 in 1990. So
wow,
I know. I
oh
always
my
hear
gosh.
my parents talk about that too. Like, oh, if you only knew what interest rates were when I was your age.
And I had my first refinance in 1993 and dropped it to 9.5, and was just thought that that was the moon, that I was able to drop at 5/8%. And within from 93 to 98, I refinanced my house 5 times, all the way down to 7%, and thought, wow, if I have a 7% rate for the rest of my 30-year term, fantastic. So, rates in the 60s were in the range of where they are now. We did see rates get to this range in probably 2009, before the mortgage meltdown and rates dropped again. Rates were around this range in 98, 99, 2000, before 9/11 happened in 2001 to drop rates. So historically, 6 to 8% is not an unusual range for mortgage rates. It's just that everybody's been used to, for the last 5 years, hearing anything from 2 to 4%. So they look at this as being outrageous. But it's, if we can get them to settle in this 5 to 6% range, it would be a good thing. But I don't think that it's going to settle for at least another year or two.
I want to ask you a question. You kind of just said something about it. And so when it was 2008, I don't even know how old, but definitely not old enough to buy a house. And now I am. And I hear a lot of talk about the housing market crashing. Do you care to just kind of explain briefly what that means to people? And if that is a possibility this time of year?
Sure. It's always possible, but there are a lot of protections in the market this time around. Prior to 2008, from about 2003 to 2008, there was a big push to allow everybody in America to have the American dream and own a home. And they started getting really crazy with programs where we could qualify people with no money down. We could qualify people with who just entered a job. We could qualify self-employed borrowers with just their bank statement showing what their average intake was for a month, without looking at tax returns and other things of that nature. So we had what we called no income, no asset loans, where if a borrower's credit score was high enough, we just used what they called stated income. They could put any income on the application. They could write down whatever assets that they said they had, and we would take that at face value. So there was a ton of mortgages put on the books. And some of these, greed came into place, obviously, and there were these mega banks, mega financial institutions in New York that started getting involved in the mortgage business, started realizing that the quality of these loans was terrible, and they were packaging these loans as mortgage-backed securities, and that's where this mortgage-backed security process came into play. So that investors would buy these mortgages, but they didn't know what the quality of these mortgages were. And then prices, because everybody was buying a home and everybody could get a home loan, prices were inflating and they couldn't keep up with supply. So the demand was high and pushed the values up. Then all of a sudden you had all these bad mortgages out there, and a few large financial institutions eventually crashed because they had too much of this bad business on their books. And that's when the federal government stepped in. So now they have some protections where we don't have some of that crazy financing going on. We are starting to see a little bit of it creep back into the market because the market's so good. We are seeing prices start to get inflated because the demand is greater than the supply right now. Builders, it's costing them too much to build a house for a spec home. So builders are only doing special construction, where custom construction, I should say, for homeowners that are willing to pay the price regardless of what the cost is. But in 2003 to 2008, contractors were building spec homes. They were putting spec homes up as fast as they could get them up because they could sell them as fast as they could. and the cost of construction was low. Now the cost of construction is too high, so the supply is very, very low. So we have the protections involved where we won't see probably the mortgage crash, but we are seeing some inflated values that people need to be careful about what price they're paying for a home.
That was great. Thank you.
Yeah, thanks, John. So I want to talk today, the nitty gritty, the adjustable rate mortgage. We already talked a little bit about it, but I just want to really get into what is it? I mean, you always hear of the fixed rate and people want to go for the fixed rate, but tell me about what an adjustable rate mortgage is and how it works.
Well, typically adjustable rate mortgages came out when these interest rates were sky high back in the 70s and 80s. When interest rates were actually in the 16 to 17% range to buy a house. So they started introducing what was adjustable rate mortgages to where if the market went down, your rate would go down. If the market went up, your rate went up. But a bank could offer an adjustable rate lower than they could offer the fixed rate. A fixed rate typically is set by Fannie Mae and Freddie Mac, and other banks could then determine an adjustable rate that was good for their portfolio. So what an adjustable rate does, and then back then, adjustable rates were just an annually adjusting interest rate. Your rate was only guaranteed for maybe 1 year. As rates started declining, they started what was called a hybrid ARM, which is what we have today, a 3-1, a 5-1, 7-1, and 10-1 are the different hybrid adjustable rate mortgages. So the rate is locked in for 3 years, and then it adjusts annually after that, or it's locked in for 5 years. So that first number is your initial lock period, 3, 5, 7, or 10. And then that second number is how often it's going to adjust after that lock-in period. They're now introducing what's called 3, 6, 5, 6, 7, 6, which means it's locked in for 3 years, but then it's going to adjust every 6 months. So we're starting to see that model come into place. But it's just a way for what you typically want to see is if you're going to do an adjustable rate mortgage, you want to get a rate that's at least 1% cheaper than the fixed rate, so that you're getting a lower rate to compensate for this higher risk. And for people that aren't sure where they're going to be 5 years down the road, a five-year 5-1 ARM is a very good product to get into, because today they could probably get into that for 5.5% or 5.25% instead of 6.25% on the 30-year fixed rate. So many people are still picking the fixed rate, but as these fixed rates go up, we're going to start seeing people look at these adjustable rate mortgages.
Okay. So adjustable rate mortgage right now might not be a bad thing.
No, it's not a bad thing, and it's never really been a bad thing. It's just when fixed rates got so low, if you had a 2.5% or a 2.5% fixed rate, you couldn't offer an adjustable rate low enough to make it advantageous for a bank to offer it. So, and the other thing with adjustable rate mortgages is most banks hold those in their portfolio, or they don't sell adjustable rate mortgages to Freddie Mac and Fannie Mae. They typically hold those. So it's a rate that's determined by the bank itself to make it profitable for them to hold that mortgage.
So if somebody has an ARM, do you recommend that they ever try to refinance or switch to a fixed rate?
Yeah, they should always.
End.
Yes, they should always stay tuned into the market, stay in tune with their mortgage person, and check rates on an annual basis to see, just like they would check their insurance premiums, check anything that they have a long-term cost to. You want to occasionally call and say, where are fixed rates these days, and see if it's advantageous to lock that rate in. Now, I know some people have taken an adjustable rate mortgage and they are perfectly fine with staying with it. They say the rate has maintained at a lower pace than the fixed rate, so they've never wanted to refinance to a fixed rate loan.
And the reason most people try to go for the fixed rate is just because it's a little bit more steady, correct?
Right. It's a stable rate with a stable payment. They know what it's going to be. They never have to worry about what the interest rate could climb to.
Mm. So you touched on it a little bit, but how often, if I am in an adjustable rate mortgage, how often is my rate adjusting?
So if you get a ARM rate today, and let's say you pick what I generally recommend to people is the 5/1 ARM, you'll lock in a rate for 5 years.
So can you explain, sorry, before you get too far, why would you recommend that 5/1?
Well, we see mortgage rates cycle every 5 to 7 years. Since about 93, we've seen in the marketplace about every 5 to 7 years an ebb and flow of the mortgage rate. So prediction wise, we don't know if mortgage rates will come quite down in 3 years. 5 years, probably in the 5 to 6 year range, we'll see mortgage rates cycle again. Something will cause mortgage rates to go low, probably not to the 3 or 2% level, but they could surely go down to 5% and it'd make it worthwhile to lock in at that point in time. With a 7/1 or a 10/1, you're paying a higher interest rate for that lock-in period. So typically a 3-year 3/1 is going to be your cheapest ARM rate. 5/1 is going to be the next level. 7/1 is going to be a little bit higher, and 10/1 is going to be a little bit higher yet. Right now, a 7 and a 10 are pricing equal or higher than a fixed rate. So there's no advantage to doing a 7 or a 10-year at this point. So with that 5-year, after 5 years, your rate's going to adjust, and then it's going to adjust on an annual basis. But there are some what we call caps. There is some limits to what it can adjust. So it's not just open to the marketplace and say my rate can go from 5.5 to 10.5 or to 15.5. There are some figures on what we call caps that stop that rate after a certain point. So typically the caps are 2 and 6%. So that means that it can't go up or down more than 2% from the rate that you have on any given change. So that very first year, if you start at 5.5 for 5 years, that 6th year, your rate can't go above 7.5 or below 3.5.
Okay.
So let's say it goes to 6.5. The next year when it changes, it can't go above 8.5, can't go below 4.5%. So it's always got to stay within that 2% range. There's a lifetime cap, and that's generally 6% from the initial rate. So it can never go higher than 11.5%.
That's what I was going to ask you, because I always think,
Which
what if the
sounds enormous, but the critical thing is that, and because of these low fixed rates, some people have been smart enough to prematurely pay their loan down, get their loan paid down faster. But some people are, well, if my rate's this far down and my mortgage payment is only this amount, I'm going to go buy a more expensive car or a more expensive truck and haven't tried to pay their mortgage down. With an adjustable rate mortgage, the idea is you do want to pay as more than you can. So look at what that payment is at 8.5% as an example, and make that mortgage payment to start paying your loan faster. If you do that, your balance is going to be lower if it ever gets to that 11.5% level, and be not as payment's not going to be as high as if you weren't paying the payment down faster. So you do want to try to take advantage of that lower rate and pay down on the loan as quickly as possible.
Okay. So just so I'm clear on like how often it happens, if I'm in a 5/1, 5-to-1, after the 5th year, it could increase every year, or it will
Right.
increase every
Right.
year. Increase or decrease depending on.
Correct.
Okay.
Can go up and down.
Okay. Awesome.
And then they have these new programs called 3656. So the second number is 6, which means it's going to adjust every 6 months. So every 6 months, you're going to see an adjustment.
So who comes up with those programs and why did they come up with those?
Every lender is going to have their own program. Right now, we're doing the 3-1 and the 5-1. Some other larger banks are now doing these 3-6, 5-6 because they want to see the rate adjust more often. They don't want to get locked into a low interest rate when rates are going up. If rates are going down, I guess they're fine with seeing the rate adjust downward as long as rates are on the decline. But if rates are going up, they want to be able to have the rate adjust on a faster basis. And I guess 1 year is not fast enough.
Okay.
Now,
So
when you're
we have to look at whether that's, are they getting a favorable interest rate for taking that high of a risk?
Right.
this is kind of just I don't want to say a funny question, but every time that rate changes, am I going to get notified, or do I just look at my bill that month and see, oh, my mortgage either went up or it went down?
Sure, that's a great question. Legally, a financial institution is required to notify you 45 days in advance of that payment change. So
Right.
they actually take the rate and adjust it 60 days prior to that next payment change so that they can calculate what the new payment's going to be and send you out a notice within that 60 to 45 day time period, because they're legally required to notify you a minimum of 40 days before that. So if your rate is to change in June, by June 15th, we've got to send you out a notice, and that will affect your August 1st payment, not your July payment.
Okay,
Awesome.
that's good to know.
Good to know.
And your rate changes on your anniversary date. So if I originate the loan, say June 21st, I originate a loan today, that's my anniversary date. The rate change, or the rate anniversary date's going to be July 1st. So it's going to be based on what that new rate is July 1st, 5 years from now. And then by July 15th, we got to have that new payment calculated. We send the notice out, and that starts with the September 1 payment.
Perfect. Thank you.
So if I'm in an ARM right now, what options do I have? Do I want to refinance? Should I stick with it? What options do I have right now if I'm in an adjustable rate mortgage?
You want to look at where your rate is compared to what you could lock in on a fixed rate, because downside of having an ARM rate right now is we are in a time where interest rates are going up. So very likely your rate's going to increase. And so if you're at an ARM rate at, say, 4.5%, you probably don't want to lock in anything, because the most you could go up to is 6.5, and today the fixed rate's at 6.25. And so just ask your lender what the index is. So the index is something like prime, or many times we use what's called the treasury indexes: a 1-year treasury, a 3-year treasury, or a 5-year treasury. Some institutions may use cost of funds index, so they look at what money is costing them, and then they each have a margin. The margin is what's added to that index to determine what your new rate's going to be, and the margin is determined at the time that you originate that loan. So right now our margins are 3% for a 3-year ARM, 3.25% for a 5-year ARM, and we use the 1-year treasury index. So if somebody had an adjustable rate with me today, they could call me and say, what do you think my adjustment's going to be? I could look at what the treasury is, I could add their margin, and I could say, well, if it was adjusting today, here's what your new rate would be. And if it's going to be lower than that 6.25, then I'm going to tell them you're probably better just to keep that ARM for now and refinance when fixed rates drop. You're not going to benefit by locking in a rate right now. If their rate's going to adjust, if they didn't take advantage of locking in a rate 2 years ago and their rate's going to adjust to 8.5, then they may want to look at refinancing to a new ARM loan or refinancing to that fixed rate at 6.25% and be 2.5% cheaper, 2.25% cheaper. So it's always good to have communication with your loan officer, your mortgage officer, and ask those questions. Where am I at today? What's it look like I want to be at when it adjusts? And what are you thinking it's going to look like over the next year or two?
So let's say I have an adjustable rate mortgage and I'm getting scared because, I have a 5/1 and now it's my first year and my rate went up and I'm just feeling like I can't afford it. And then I try to contact you and get a fixed rate. Is there any reason why I would maybe get denied that? Is that a possibility? And what are the reasons that I would maybe get denied?
If the fixed rate causes your payment to be higher than the debt ratio that's allowed, yes, you could be denied. If you had a problem with your credit and maybe not missed any mortgage payments, but maybe you missed a credit card payment and your credit score dropped, or maybe there's a medical collection item on your credit that you didn't realize. So it is possible that we could pull your credit a year down the road, 2 years down the road, and the credit scores drop because of a problem, and that would get you denied to do a refinance, even though you've been making your mortgage payments all along.
Yeah, so it's not just about making your payments, but it's about keeping tabs on the rest of your financial house.
Right. You've got to maintain your credit and always keep track of what's going on your credit because it can affect. We had people trying to refinance to a lower interest rate the past 2 years that weren't able to because they didn't pay attention to their credit and they had some medical collection items and they weren't able to get qualified.
Wow.
So, John, I know that you get a free credit report every year. You can go in, they're required to give you one a year. Is that correct?
You can go to annualcreditreport.com and you can pull a free credit report from all 3 credit bureaus on an annual basis from that website.
Okay.
Now, you can go to each thread, right, annualcreditreport.com. That's one central location that you can go to. You can go to each of the 3 credit bureaus and ask for a free and request a credit report, but this is an easier way to do it. Now you have to go in and request one from one, and then you get that report, log out, log back in to get it from the other one. But even if you just get one credit report from one of the credit bureaus, that's going to keep track, usually do a good job of keeping track of where your credit is. They all cross-report, what they call cross-report, which means if your information's on TransUnion cross-reports with Experian and Equifax. So Experian and Equifax is going to typically have that same information.
Great.
That's great.
Now, those don't give you a free credit score. You have to pay to get a credit score, but it does give you a free credit report. And I always recommend people to use the annualcreditreport.com, not free credit report or Credit Karma. If just know that if you use those are third-party organizations, and the only way they're able to provide that information to you free is because they're selling your name to somebody. They can't sell your credit information, but they can sell your name and address and phone number based on what's called a pre-approval process. So let's say Farmers State Bank we wanted to solicit everybody that has above an 800 credit score in the city of Marion. We could go out to Credit Karma and buy a report of everybody in Marion that has above an 800 credit score that's on Credit Karma, and get that information and then solicit them with some sort of pre-approval offer. You're pre-approved for a mortgage loan. Contact us and see how much you're approved for. So that's how these agencies provide free information to you, is because they're selling your information. and they're also not credit reporting repositories. So by signing up with them, you're giving them access to your credit report. They're not regulated by the federal government to have protocols in place to protect your information. So
Wow.
some of these, we're always seeing where there's a certain amount of our debit cards that the information gets stolen, tapped into. Um, Flagstar Bank, there was an announcement today where a company called Flagstar Bank had 1.5 million customers who their information got tapped into by somebody who broke into their system. So you don't have protections with somebody like Credit Karma. And so, I just always caution people that it's not, it's better for them to use annualcreditreport.com or go directly to TransUnion or directly to Equifax or directly to Experian.
Good call. So everybody go to annualcreditreport.com or directly to the 3 credit bureaus that we talked about before. So instead of going to those crazy websites, it's always safer. Another question, John, I know, is there anything else on adjustable rate mortgages you really want to hit home with people watching right now?
The main thing is, again, just going back to that idea that to make it worth your advantage, the general rule is you need to get a rate that's 1% cheaper than the fixed rate to make it worth your while. 2% is even better, but 1% is kind of the minimum. So people used to call and say, well, what's the gauge for refinancing? And we would tell people if the rates drop to 0.5 to 1%, that makes it worthwhile to refinance. So if you've got an adjustable rate offer at 5.75 and a fixed rate offer at 6.25, it's probably better to still lock in that fixed rate. There's not enough of an advantage with that adjustable rate. But we are going to start seeing, with constant rates going up, we're going to see adjustable rates that are probably going to be 1 to 1.5% cheaper than the fixed rate, which definitely makes them a viable product. Pay attention to what those caps are. That tells you how much they can change every 6 months or a year, and what that lifetime cap is. And go ahead and have your banker calculate what the payment would be at that highest interest rate. If that's not a payment that you can manage, then you may want to look at a cheaper priced home or wait for rates to go down.
That's so good, because I sometimes feel like we're afraid to ask those questions when we sit down with the loan officer. You just want to get in and get out and get your loan that you need, but it does pay to sit down and go through those scenarios together, whether an adjustable rate will work better for you.
I'm in a group called BNI, Business Networking International, and it's just a group of business people who network and try to refer business. And one of the things that I drive home all the time in the meetings is I'm amazed that people they treat their mortgage like their auto payment. It's just, what's my payment? And that's what got us into the problem with the mortgage meltdown, is there were a lot of adjustable rate mortgages back then. And people said, well, just tell me what my lowest, give me the lowest payment. And then when payments started going up, they couldn't afford it. And then all those homes were foreclosed and abandoned. That was another reason for that mortgage meltdown, is people getting into mortgages that the payment would go up. Another one that was a tricky program is called a graduated payment mortgage. Is the bank would say, okay, we'll make your payment this low right now, and we know that your income's going to go up, so we're going to graduate your payment every year based on consumer price index, because we think your income's going to go up every year, so you should be able to manage this. Well, naturally, yeah, Ashley's eyes are exactly.
That's not the truth.
Payments increased faster than people's incomes.
Right.
They got to that fifth year where they had to start paying the maximum payment, and they couldn't afford it. So people have to look at all those issues and make sure that it's the right product for them. Ask the banker to say, what's my maximum payment if it ever goes to this amount. But as I was talking about with BNIs, I always mention, I don't understand why mortgage in your home is your biggest asset next to your retirement, to your 401. And in some cases, if people don't have a 401k built up quite yet, the house may even be the biggest asset that they have, but it's at least your second biggest asset. And people trust that information to the internet and let somebody just quote a payment and say, okay, that's good for me. They don't actually talk through what programs are available, what interest rates are available. Right now, everybody should be asking not only what's the fixed rate, but what's your adjustable rate, and looking at, is this a viable option for me?
Well, that kind of leads to another question. Is it a good time to buy a home right now? Is it still worth it? Should I wait? Should I hold off?
It's still a good market time to be buying a home. Values haven't overinflated. They have gone up. The demand is a little bit greater than the supply. We've started seeing the demand come down a little bit because of these higher interest rate mortgages. But you also have to look at, if you're renting, if you're living at home free of charge, you may want to stay living at home for another few years. But if you're out renting, you've got to realize that your landlord's going to be increasing your rent because they're going to be paying higher rates, higher costs. So you're always looking at that rent versus purchase scenario to say, is it a good opportunity for me to buy and get out of the rental situation? So, if your rent was going to remain flat for the next 5 years and not go up, you may want to wait for mortgage rates to come down or prices to come down. But generally, that's not the case. Your landlord's going to be increasing your rent. And most of the time, you can get into a home and purchase a home for a cheaper price than what your rent payment is.
Good.
Okay, so if a customer isn't buying now but plans to soon, what are your recommendations to get ready to buy a home, even if it's in the next 3 or 5 years or next year?
Sure. We always encourage people to get pre-qualified. It's no cost to them when they come to Farmers and get a pre-qualification. We'll pull their credit. We'll look at their income. We'll see how much time they've been on the job, how many years of credit that they've established. We'll look at the credit report, let them know if there's any issues on their credit report. And then we can crunch some numbers and say, okay, based on your income today, this is what you can qualify for. And then if they have some projections of what they think their income would be over the next few years, we can show them what they could buy. So if somebody knows, if they're in a union job and they know that they're going to have a minimum of a 2% increase every year, we can go ahead and put that increase out the next 5 years and say, okay, here's what you could qualify for in 3 years. Here's what you could qualify in 5 years. We can look at their assets and see how much down payment that they have, and then let them know, here's what you could qualify with a 5% down payment today. If you saved up 10%, here's what you could qualify for. If you saved up 20%, here's what you could qualify for. So I tell people it's never too soon to sit down with us and do some planning so that they can then plan their income and their savings to say, here's when the right opportunity is for me to buy. And I've had people come in thinking that they're 3 to 5 years from buying a home, finding out that they could qualify for the home that they want to buy today. They don't need to wait. Some people still think you have to have 20% down, and they're shocked when they come in and find out we could do an FHA loan with only 3.5% down, or a USDA loan for 0% down, which, by the way, we have mortgage 101s on those issues from a couple of years ago. If they go to our MyFSB and look up mortgage 101, we've got all about VA loans, USDA loans, and FHA loans out there.
Speaking of those down payments, I have a burning question. If I come into your office and I'm, looking for a mortgage, whatever my down payment is that I can afford, will that ever affect my interest rate?
It can in some cases. Generally, it doesn't, but it does in tandem with your credit score. So if you have a credit score above 740, whether you put 5, 10, 15, or 20% down is not going to affect your credit score. If you, or credit rate, interest rate. If you have an FHA loan and you only put 3.5% down with a credit score above 740, it's not going to affect your interest rate. But if you have a 640 credit score, then a 5% down payment is likely to be a little bit higher interest rate than somebody who's putting 20% down. FHA loan with only 3.5% down with a credit score of 640 versus 740 is going to pay a higher interest rate. So your credit score is the biggest factor that goes into your interest rate. The second biggest factor is what type of loan program, conventional or government program. And then the third factor is down payment size.
Great.
That's good to know. So it does pay to have a relationship earlier with your banker.
Sure.
Sounds
Yeah,
like.
if you find that you have a 680 credit score and you don't really have bad credit, but you want to have an opportunity at having the best interest rate, we can look at that and see, well, what can you change that will move that credit score from 680 to 740? And we can't give you exact numbers, but I can look at your credit cards. How are you using your credit cards? If you've maxed out your credit card, that's probably a good reason why you're at 680 instead of 740. If there's one missed late payment from 2 years ago on a credit card, and you feel like you've never made a late payment, you can go back and dispute that with the credit card company and try to clear that up. That one late payment may be why your credit score is 680 instead of 740. So a 680 credit score is still a very good score, and you can qualify for a mortgage, but you're going to be in that next tier of interest rates rather than being in the tier of 740 or higher. And everybody wants to be at an 800 credit score, and I can, it's fine. Some people get disappointed when they hear 750 or 745. Anything 740 or above puts you in the highest caliber of credit and gets you the lowest interest rate. So 750 is fine, but it's not going to get you a better interest rate. 800 is great, but it's not going to get you a better interest rate.
Okay. Well, that's good to know. So I know we get a free credit report every year. How do I find out my credit score?
You can do the cost, and usually it's not that expensive. It's $30 to $40 to pay to have a credit score from one of the credit bureaus. I wouldn't worry about getting a credit score from all 3 credit bureaus. I would just request a credit score from one of those. Now, if you use Credit Karma or freecreditreport.com, one of those agencies, again, if you know what the risk is, you can use that as a gauge. That's not going to be the same credit score that we pull whenever we pull credit for mortgage loan, but it is a bar to where you know if your credit score is dropping or if your credit score is going up. And generally, those scores can be as much as 50 to 100 points off from your actual credit score. So probably one of the things that's maybe more accurate is if you have a credit card that tracks credit score for free. That's another good measure to look at because they generally are pulling that directly from Experian, TransUnion, or Equifax. So I watch my credit score on Discover, and it's usually maybe 10 or 15 points different than if I were to pull my mortgage credit.
Well, that's good to know. Very good. I'm trying to think. Anything else you want our listeners to know today, John?
I can't think of anything other than just to express again that it's very important that if you're looking at buying a home, sit down with your mortgage lender, come to Farmers State Bank and sit down with us. We can do some pre-qualifying and make sure that you're getting into the right mortgage product and work with somebody local. I can tell you when you work with somebody over the internet, they're giving you the loan product that makes them the most money. They're not looking out for your benefit and giving you they're waiting for you to hear, yeah, that payment is okay, and then that's the program that they're locking you into. Whereas we want to have a customer relationship for a lifetime, and we're going to find the right product that fits your needs. And then if it is an adjustable rate mortgage, we're going to keep that information on the system. Every time that I've been doing this for 37 years, every time that rates have gone down, the first thing that I do is pull a list of every adjustable rate mortgage customer that we have and start calling those people and saying, hey, here's where your rate is, here's where rates are going, you need to start refinancing. I can
Great.
tell you that Rocket Mortgage and some of those other companies aren't going to do that.
No, definitely not. So, John, where can people reach you if they want to sit down and start talking about some of this stuff with you?
Well, they can apply online at myfsb.com, but they can reach me by jstreuter at myfsb.com or call me. That is my bank cell phone number. You can reach me anytime at that number, 618-528-1188.
Awesome. Thank you so much, John, for joining us. I'm sure you answered lots of questions that were just kind of sitting unanswered right now in these uncertain times, I guess. So we
Sure.
really appreciate your time. I know it's so valuable. But
Yeah, thank you, John.
Very good. You're welcome. Have a
Well,
great afternoon.
you as well. Thanks, John.